Everybody knows that indexes and index funds always beat actively managed funds. Some statistics you're used to hearing is over a 1-year time period, 60% of actively managed funds underperform the S&P 500 index. Over a 5-year horizon, that's 65%, and over a 10-year horizon, 80%. Okay, that was a statistic that I found. I'm reading that. I've heard as high as 90. I'm not sure where all these studies come from, but it's becoming common wisdom that indexes beat, and that is not a bad way to go. But today, I wanted to take you into analysis I do once every 6 months, comparing indexes to what I invest in my growth engine, my bucket 2. It's all equities. It's where I expect all my growth out of. I have bucket 1 with 10 years and fixed that I need from my assets. I got 10 years in there. It's not a full 10 years. It's 10 years minus my income coming in during that 10-year period, things like Social Security, right? Okay, so I have an American fund portfolio. I've got 5 funds. I'm going to show those 5 funds to you. And then I'm going to compare that for fun. So I got 3 funds, 3 different portfolios I'm looking at. My American funds, 5 funds, I'm going to use indexes, like the total stock market and international market. So that's another portfolio. And then a final portfolio is one I was given from a financial advisor 6 years ago, or actually, God dang, I've been retired 6.5. About 7.5 years ago, when I was meeting with financial advisors and looking for proposals, they gave me 10 funds for my growth engine. We're going to take a look at all that in Portfolio Visualizer to see what the data says. Okay, so I'm going to share my screen. Here we are in Portfolio Visualizer. This is free, but it only goes back 10 years. It used to go back more than that. It's a paid version. It's like $35 a month, something like that. Kind of pricey, I think, for the paid version. But we're just going to use the free version here. So Portfolio 1, I've got 83% in US stocks. It's VTI. And 17% international. 17% international was the number that I decided that I want in international to diversify my investing. So to try to make things equal, I use 17% there. So that's in Vanguard VTI. And then VXUS is the index portfolio. It's right here, index portfolio. And then I have my American funds. I got 5 of them, 20% each. I am going to hopefully show those to you here or walk through those. Yes, okay. So my first one is AMCAP. It's growth-oriented U.S. large cap companies. It's kind of like an S&P 500, but it's got a lot of mid and small cap in there. New Perspective, it's a global fund, looks for opportunities across the globe, only about 50% in the U.S. Growth Fund of America is diversified U.S. growth stocks. It's like maybe more like the NASDAQ or just all growth. And then Washington Mutual, it's a large cap value. So American funds, they're looking at value funds that are under market based on economic trends. They also pay dividends. And then Fundamental Investors, it's a blend of growth and value globally. Okay, so those are the 5 funds I selected for my portfolio. These are what I actually have in my portfolio, 20% in each. So let's go on to portfolio 3, which is 10 funds. And I'm going to try to read these things off for you. The first one is the Spider 500, S&P 500. So that's pretty simple. The next one is T. Rowe Price Blue Chip Growth Fund. Next one is Fidelity Mid Cap Stock Fund, iShares Russell 2000 Small Cap, American Funds Euro Pacific Growth Fund, iShares MSCI Emerging Markets ETF, Vanguard Real Estate ETF, VanEck, VANECK, gold mines. So they got some gold in here, gold exposure. iShares US Technology, and then Vanguard Healthcare Fund. Okay. Now the expense ratio from those this financial advisor, they range from like the Spider SP 500 is like 0.09%. The highest, I mean, there's 0.2%, 0.67, 0.13, 0.72, 0.5. So not, there's nothing over one. The highest one is 0.83, the Euro Pacific non-US equities. My funds are basically, they're like 0.61 expense ratio. Now, that said, Portfolio Visualizer takes expense ratio in consideration. So they take that off. So these are apples to apples comparison of these funds. So again, first fund is all equities, 83% US stocks in VTI, 17% international. And then my bucket 3 are my 5 American funds. And then the advisor recommended are the 10 advisor ones, which include some gold and real estate and some sector focus. So I just click Analyze Portfolio. It only goes back to August 2015, 10 years. Okay, so let's just look at 10 years and see what we got. So what Portfolio Visualizer does is says, hey, okay, this equity portfolio here, the 83-17 international, they got over that 10-year period 12.1% return. Okay, standard deviation 15.6. This is just a high level overview. Then my American funds, my 5 got 12.6 versus 12.1, so a half a percentage more compounded annual growth rate, which is big. 15.4 standard deviation, so slightly lower standard deviation. And then the advisor recommended actually had 12.6, equaling my performance of my fund. So half a percentage better for both the advisor recommended and my bucket 3. So let's look at exposures. Look, some of this is just to let you see Portfolio Visualizer too. You can see this is the indexes there. You know, here's the international 16.8, and here's the US 82.3, and then there's a breakdown of mid cap. Mid cap is 19 versus large cap of 73. Inside of my American funds, almost 80%, 17.6, 80% US, 17 US or international. 83% is large cap, a little higher. And then you can go down to the advisor recommended, a little lower. US stocks 75, let's say, and international a little higher of 23.8. So I didn't dictate what the advisor told me. I just took what they said. So a little higher exposure. International large cap 69%, which is a little lower than, you know, mine is 82 point, you know, quite a bit lower, 82.3, and which is lower than the index of 73. So there you go. I'm just going down the tabs over here to the left to see what we find. Active return. So here's the return side by side. The blue bar is the indexes. My bucket 3 is green, and the advisor recommended is gray. So you can see here in 15, my bucket 3 really lost a lot less than everybody else, but lost more in 2016. Did the best in 17, did the best in 18, did the worst in 19. So, you know, I'm not going to read all these to you, but you can see year by year who wins. The advisor recommended one of the things that's going to jump out on that is gold. Gold really dominated. Without gold in their portfolio, and if I would have said, hey, no gold, this would have lost to my American funds easy. We'll see that in a second. So you can look at metrics, any metric you want to look at here. I'm not going to spend any time on that. Here's annual returns by fund. So the top line is 2025. Let's look at that for a second. This is a long list of things, but you can see, my bucket 3 is getting 12% in 2025. The almost 9% for the indexes. So I'm doing quite well this year. The advisor recommended is 11.73. And then out here to the side is all the individual funds. So let's swing over there. And again, the top line is 2025. Look at so far 2025. The gold, this one's gold, 52. I mean, insane. And then, back, what is this? Another 52 back here. So gold has just been on a tear. Historically, it hasn't done well, but in the last few years, it's been going freaking crazy. A lot of, 39%, 23%. I mean, just blowing away the S&P 500. The S&P 500, if we look at 2025, S&P 500 is at, or total stock market. Let's say the total stock market. I do have the S&P 500 on here. 8.54, gold 52. So the advisor did pretty well adding gold in here, and some of the other funds they got have not done too bad. The Russell 2000 is not worth doing much. The healthcare fund, look at that, minus 5.4 if you've focused on a sector. It didn't perform well at all. My voice is going on me. That's why I have to get my Buc-ee's drink out here. You've got monthly returns on here. I'm not going to go into that at all. Rolling returns, so rolling 3-year returns. So it takes the average of the 3 years, this year and previous 2 years, creates a dot, kind of smooths out things just a little bit. I don't know what allocation drift is. So I'm going to stop sharing my screen. My point is not that indexes are bad. I'm just saying, hasn't been my experience. I got invested in American funds when I started working at the age of 22. That was all we had access to in my 401k, and they've done extremely well for me. I don't know if they're in the 2, 5, 10% all the time. I don't carry just one fund. As you saw, I have a blend of funds, and they have done extremely well. Yeah, you can always go backwards and say, hey, Joe, what if you would have just been in the S&P 500? Oh, yeah, that sounds great, but I don't invest backwards. I invest for the future. And international funds is where I wanted to be in retirement. I wanted to have some of that in there. So this is what I was looking at is VTI and VXUS, and I chose to stay with American funds, and it's done quite well for me. So 1, I wanted to show you this tool. 2, I wanted to say indexes are great. They're great, great, great. There's lower risk. You're never going to have FOMO, fear of missing out, because I do compare it to the S&P 500 all the time, and if I wouldn't have, if I just have the S&P 500, I wouldn't have any stress or fear of missing out. But these American funds have done great for me. So this is just a tool I use, and every 6 months I do a comparison. And so far, I'm extremely happy with my American funds. It's Joe out.